Let's talk about DSCR loans in 2026, because if you're investing in real estate this year, the rules have changed once again. I've been helping investors navigate DSCR financing for years, and 2026 is shaping up to be one of the most important years yet for this product. So let's break down exactly what's new, what's getting tougher, and how to position yourself to win approvals and better terms on your next loan. Quick refresher, what is a DSCR loan? DSCR stands for debt service coverage ratio. And it's a metric that lenders use to determine whether your property's income can cover its debt expense. In plain English, they care more about the property's cash flow than your personal income. If the property brings in enough rent to cover the mortgage, taxes, and insurance, you're good. And that's why DSCR loans have become so popular over the last few years, because they give investors freedom from tax returns, W-2s, and personal income statements. And as more and more investors find out that these products are available, they want to use them instead of other financing conventional methods. So what's changing in 2026? Now here's where things are looking a little bit different. Lower minimum DSCR ratios. Many lenders that used to require 1 or 1.25, they're now introducing programs which allow much lower minimums, and in some cases, no debt ratio at all, or DSCR at all, to be calculated. And this is valuable in a rising price market or environments where the future income of the property, it just doesn't represent the current use or the current value of the property. Better rates, better rate sheets. We have seen interest rates come down from the peak back in 2024, but not very evenly. And many lenders are adding risk premiums for smaller investors, first-time investors, and for cash-out refis. In 2024 and 2025, you could find DSCR rates in the 7 to 8% range, but in 2026, expect them to be a bit better, more towards the 6 and 7% range, depending on your credit and your leverage or loan to value. Higher risk properties, like mixed use, or 4 to 8 unit, will be higher interest rates. And all lenders have significant premiums that are added for these higher risk loans. Simpler documentation and data requests. Even though a DSCR loan is no income, lenders always have to do full underwriting of the loan file. And some do require rent verifications as well, especially on short-term rentals like Airbnb. On long-term rentals, they're generally going to want to see a copy of the lease agreement, but there are some cases, if you have enough equity, where that lease agreement requirement can be completely waived. And vacant properties, they aren't an issue with all lenders like they used to be. I have several that I work with who lend on vacant properties and use the rents as shown on the appraisal 1007 report, and also no seasoning on cash out. So these are aggressive options that just a couple years ago weren't even available at all. So why all the new optimism? What is the market forces behind these changes? Well, there's really two main reasons. The first thing is investor performance data. The lenders now have several years of performance data to look at and analyze, and they've refined their loan parameters to ensure stability. The other thing is risk premiums. They've added higher risk premiums to certain loans. So the investors and the secondary market are demanding safer, more predictable loans. So the loans that have higher risk have higher standards, and the interest rate reflects that level of risk. So you'll see higher interest rates and higher premiums on those higher risk loan types. This is all really good news, and if you have experience in investing in real estate, a good payment history, and all your documentation ready, you're going to stand out in this market. Strong borrowers are being rewarded with really good rate discounts and faster closings and easier processes than ever before. Now, the typical timelines that I see with DSCR loans can be as little as 2 to 3 weeks from start to finish. The key to getting a quick DSCR closing is ordering the appraisal early in the process. So something I've been doing with all my clients recently is ordering the appraisal at the time of the application. As soon as we're putting that application in, we're also ordering the appraisal. And the reason that's so crucial is because with these type of loans, the appraisal drives the whole process. They're appraising the property value, which determines your loan to value, and they're also appraising the rental income using the 1007 form. And those two metrics, the value and the rental income, are the pieces pieces that drive the whole DSCR process. 9 out of 10 times, if there's a problem getting these loans done, it's because of the appraisal. So if we can get that appraisal earlier on in the process, get it early, we can mitigate those issues or avoid them completely altogether. What smart investors should do right now. So here's how you can get ahead and stay ahead in 2026. First of all, you want to know your DSCR math. Before you even contact a lender to apply for a loan, do a rough calculation of your DSCR ratio. So you're going to figure that out by taking your actual market rent for the property and your principal, interest, tax, and insurance, and you're going to divide the rent into the PITI, into that new mortgage payment. You want to see that the rent is equal to or greater than the PITI, ideally, and really aim for 1.25 to 1.5 times to get the best pricing, but 1 to 1 is really entry level where you want to be. The next thing you want to do is stabilize your income. Long-term leases are favored over variable Airbnb revenue, like short-term rentals. So if you're using short-term rental income, you really want to make sure you've got at least a 12-month history in place to get the loan done. And if you're using that long-term rental, long-term lease, then ideally have a copy of the lease ready to go so that you can show your lender that and they can do that calculation early on. Get your entity clean. Most of these loans we do using LLCs. So if you're a business owner or you have an LLC that can actually own the property, you want to have all the documents ready, your operating agreement, EIN number, certificate of good standing, all of that. Lenders are requiring additional LLC reviews above just a regular underwrite. And many, as a bonus, limit the credit reporting on these types of loans. So there's a huge advantage to taking a DSCR loan under a property in an LLC. And the big advantage is that with most lenders, they won't report to your personal credit report when you do that. That can open up a lot more borrowing power for you, especially if you're trying to scale your portfolio or take other types of mortgages that aren't as lenient, like conventional or government-backed loans. The other thing you want to make sure you do when you're getting a DSCR loan is work with a lender that specializes in this type of financing. The difference between a general loan officer and an investor-focused one can literally be the difference between approval and denial. So really go out, vet your loan officer. Make sure you're working with someone that has reviews, ratings, and a reputation to have helped investors just like you. This is very different from conventional and government financing. So if that's what you're seeing they do, find somebody else. Let me give you an example of a client from 2023 to 2026, a little bit of a case study here for you. So in 2023, I had an investor who contacted me and they wanted to buy a home, but that home only had a debt or DSCR ratio of 0.8. And my investor could only put down 30%. So in order to get that deal to work, my client had to put down 35% to get that ratio to 1 to 1. Now today, in 2026, there are several options that we could use with that scenario where he could have done that original idea of just putting 30% down at the 0.8 DSCR. The difference is that now new investor risk appetite is a lot better because they have data on all these loans performing. And it's good news for real estate investors in general. Preparation and timing matter more than ever. So what's the future of DSCR loans? Let's talk about going beyond this year. We're seeing a ton of innovation in the mortgage industry and in the secondary market who buys and trades these loans. They're trying to make more and more availability of DSCR and investor financing. So they're expanding the box, creating new products, creating new opportunities, really opening it up for more options, different types of properties, and better terms. The other thing is automation is happening. We're seeing AI take over in a lot of other industries, and mortgage is no different, especially around underwriting and appraisals. So what we're seeing there is a lot of companies are now using AI to automate the appraisal process, whether it's on the value of the property or on the rental income, the rental qualification of the property. And you can expect that over the next couple years, we're going to see more and more automation and AI being used in the underwriting and approval of these type of DSCR loans. DSCR are absolutely one of the most powerful tools for real estate investors in 2026, but you have to play by the new rules. Know your numbers, present clean documents, and work with a lender who understands this product inside and out. If you want a personalized breakdown of your DSCR ratio, or if you're planning to buy or refinance this year using one of these loans, reach out to me. I'll walk you through exactly what lenders are looking for right now. And if it's your first time watching us on the channel, go ahead, hit subscribe, and make sure you don't miss another one of our videos. We'll see you next time.